Testing 1 2, testing 1 2, check 1 2, check 1 2. All right, hey, we're back. We are back. It's good to be back. Ed Ponsi here, your FX educator, here on behalf of FX Street. Once again, here, let me get this chart set up a little bit different. There we go. And this way we have a little room in the margin so I can see your comments coming in. So please keep in mind, this is your room. So feel free if you have questions for me. You can ask me anything: technical, fundamental, risk management, currencies, stocks, commodities, everything. Right? I love it when we get great interaction from our students here. I got a chart here. I thought this was interesting. This is Lululemon, and this stock is up 88% this year. I believe it or not, I think it has a chance to do very well next year. Look at the way it pulls back after earning. Hits an all-time high, right? And that's on December 11th. And then it pulls back sharply after earnings. You see the green arrow? Lululemon drops exactly 38.2%, 38.2% Fibonacci retracement. And now we're bouncing back up and we're heading back for the highs. And I think this stock is going to go higher. And first of all, the trend is inarguably higher, right? It just continues to move. It's been going up pretty much all year. It's just been going steadily higher. And now you're getting very close to the all-time high again that was set on December 11th. So that quick 38.2% pullback was nothing but a buying opportunity, folks. And now, even if you're not in yet, I tell you, there's a couple other reasons to own this stock. And people say, well, Ed, it's already gone up so much. Well, consider this, though. They have untapped markets. You know, the Lululemon is athletic leisure wear. You probably best known for making women's yoga pants, right? And of course, it's become something of a fashion trend that wearing yoga pants, out in public is just as common these days as wearing blue jeans out in public. So the thing is, though, that this company has huge untapped markets. For example, men, right? I don't own anything by Lululemon, and I suppose most men do not, but they are making great inroads into selling men's athletic leisure wear. I'm sure they don't look exactly like the yoga pants because, look, I don't think most guys are going to wear those, and that's probably a good thing. But they're creating something for men, and men are starting to buy it, and they think that over the next 2 years, their business will double in terms of the men's business, should more than double. Not only are they expanding um, intersexually from women to men, they're also expanding internationally. They expect the business in China to quadruple over the next 2 years. So, can you imagine? Can you imagine 1.3 billion people in China? So half of them are women, right? And that's a lot of yoga pants. That's a lot of yoga pants you could sell. That's like 750 million yoga pants. Okay. If we can just get each lady to buy one pair. And of course, but the thing about this product is the customers love the product. You see, guys, you don't understand it because you don't own a Lululemon pair of pants, and neither do I. But the ladies probably get this. They are willing to pay more for a Lululemon than pay less for a cheaper version made by Nike or Under Armour or the Gap or one of the other people who are trying to get in on this bandwagon. So in that sense, I would compare it to Starbucks. Starbucks sells coffee, right? And you can buy coffee anywhere, right? And Starbucks sells coffee for more than anybody else. So why do people buy it? Because there's something different about it. There's something different about the product or the experience or both. And that's the key. All right. That's the key to a successful company, right? I think that's something. And now, speaking of Starbucks, so we're talking stocks a little bit here. I just thought the chart was very interesting there for Lulu because of the pullback, the 38.2 pullback. Starbucks, this looks like a cup and a handle to me, right? If you look at this area, we'll see if we can shade it. Like this, I guess. This area looks to me like a rounded bottom or a cup and handle. Okay. And so I mean, you can see the round bottom, and now it's just trending sideways. It just needs to break out. So it's right on the tip of breaking out of a cup and handle. And the way that we measure potential gains on something like this, it looks like the top here is 89 and the bottom is 81. So I'm measuring the rectangle from top to bottom. The top is 89, the bottom is 81. So that's 8 points. So if it breaks out, and it's right on the edge of breaking out, if it breaks out, if the rectangle is 8, and I'm calling it a rectangle, it's a cup and handle, it's a rounded bottom, you would measure them all the same way. You measure the height from top to bottom. In this case, it's $8 from top to bottom. The next thing you would do, you would add that $8 onto the breakout point. So the breakout point is approximately 90. I think if it hits 90, we can say it's broken out. And it should run $8 once it breaks out. It should run to 98. 98 would put us very close. 98 would put us right up by this high. And that would be a good place to sell, in my opinion. Let me put a line there so you can see what I'm talking about. Okay. Put a line right here. Boom. That's 98. That's where I believe this is heading. We'll make it black. We'll make it a dotted line. There you go. Look at that. Pretty. That's where I think Starbucks is heading. I think Starbucks is heading to 98. And as silly as it seems to pay like $6 for a cup of coffee, every once in a while I'll do it. I'm not addicted to it like some people I know, but every once in a while I'll spend $7, $8 on a cup of coffee at Starbucks because it's just like a special treat. And people love it. This company's still growing. They're expanding. They're not in the U.S. In the U.S., they're pretty saturated. You really can't go anywhere without finding a Starbucks in the U.S. But China and much of the world, really lots of room for growth. And one of the things you might want to look at, can I pull up coffee? This is the only thing that bothers me about it. What you're looking at here is an ETF that mirrors the price of coffee. And you can see the price of coffee has jumped from third. It looks like this move is about a 50% move in the price of coffee. Why does that not scare me when it comes to Starbucks? I think there are a lot of people who will buy less coffee if the price of coffee rises just because of economic reality. But honestly, the people who go to Starbucks aren't worried about it. If they're willing to pay 6, they'll pay 7. What do you think of that? Because the people who spend $6 on a cup of coffee are not price conscious. They're not worried about the price. Okay. So what you're looking at here is the price of coffee is rising. And, quite frankly, I mean, if you're Starbucks, you don't want to see that price going up and you don't want to see it going up sharply. But the price of coffee was quite depressed, and now you're getting up near resistance. So it seems to me like this rally in coffee could be coming to an end, right? Because where is resistance for coffee? It's right here. Why are these lines pink? What a horrible choice. Okay, there's your resistance on coffee. So I don't really think coffee's going to go a whole lot higher. I mean, it could always break resistance. That's true, but I don't really see it going much higher from here. And I think Starbucks customers are much more likely to be able to absorb a price increase than, for example, people who buy just regular coffee brands. And SJM is a stock where this is just regular coffee. This is the biggest coffee seller in America. They make Dunkin' Donuts coffee and Folgers and all kinds of stuff and all kinds of different brands around the world. I couldn't even name them all. You go to Smucker's, Google Smucker's brands, and it'll take you to the website. And you're going to see like they make like a dozen different coffee brands, right? So they're the biggest coffee seller in the U.S. The chart looks awful though, right? And the reason is, again, the price of coffee going up is bad for Smuckers. It's very bad. In fact, as I look at this chart, here's what I'm thinking. Hey, ready? This is going to be fun. Okay, so there's support. Smucker's getting very close to breaking support, is it not? Very close. And if it breaks, that support actually goes way back. If it breaks, I think it could go all the way down to here. Big old descending triangle. Now you can see where I'm drawing from, but I'm not going to measure from all the way up that high. I think that's not the right way to do it. The right way to do this is to measure from where the two lines are both meet each other. So we go from 118 down to 102. That's $16. So if it breaks, it could drop another 16 from 102 down to 85. Only there's big support at 91. I think Smucker's is going to 91 because guess what? The people who buy coffee from Smucker's are price conscious. The people who buy coffee from Starbucks are not. So what's the trade, gang? How about this? Are you ready? Long Starbucks and short Smucker's at the same time. This way, the trade is not dependent on market direction. I'm going to go long one stock and short one stock in equal dollar amounts, not equal share amounts, equal dollar amounts, because the share price of the two stocks is different. You go equal dollar amount or whatever currency you're working with. I'm working in dollars because I'm an American. But I think the stock's going to drop to 91, and I think Starbucks is going to go higher. What do you think of that? All right, so it's kind of a very interesting juxtaposition, but it actually makes a ton of sense if you think about it. Okay. While we're on these charts, so that was pretty neat, huh? You weren't expecting that. Neither was I, really. But the charts just kind of speak to you sometimes. So anyway, there's a stock setup: long Starbucks, short Smucker. Let's look at the S&P, and man, just look at that. It just keeps going higher and higher. And then, of course, that's today, the 27th. It just won't quit. This market just won't quit. All right. And, you know, it's hilarious to me that a Nobel Prize winning economist claimed that when Trump won the election in 2016, the market would fall and never, he said it would never recover. This guy won a Nobel Prize. He writes for the New York Times. How did that prediction work out? The market would fall and never recover. Meanwhile, I believe we have hit close to 140 all-time highs in the last 3 years. And guess what? Right now, guess where we are? All-time high, just like yesterday. It's Groundhog Day in this market, folks. If you're not long, you're wrong. Okay, you cannot look at that chart and forget what you know and just look at the chart. You cannot fight it. Okay? Fighting the chart, it's not what we do. There are plenty of reasons to think that this could fall. And I do think it will fall, and it could fall in the coming year. But I lost a big reason there. I really thought that China was not going to come to an agreement with the US. You know, I'm still very skeptical, but the market seems to buy into it. The market really seems to believe that something good is going to happen between the US and China. You can't fight it. You got to cover your shorts or else get run over, right? I mean, I didn't think Tesla was going to go this high. Why is Tesla going so high? Because so many people were short. And as this thing jumped up after earnings, the shorts begin to cover. Now, how do you get into a short trade? You get into a short by selling. So if I sell to get in, how do I get out? By buying. This is what is known as a short covering rally. The shorts start losing money and they buy to get out of the trade, which just pushes the stock higher and higher. It's called a short covering rally, also known as a short squeeze. So if you ever hear that term, short squeeze. And this was one of the most heavily shorted stocks in the market. About 50% of the outstanding shares, which is also known as the float, about half of the float. In other words, about half of the shares of Tesla that were floating around out there were sold short. And now all those people are wrong and they all got to cover. And it creates massive buying. And there's a big lesson in here, folks. Shorts, if everyone is short a stock, that is not necessarily negative. When I see that a stock is heavily shorted, or any commodity or anything is heavily shorted, even a currency can be heavily shorted. Do you know what I think when I see that? If a currency is heavily shorted, or a stock or a commodity, those are future buyers. Future buyers. Every short is a future buyer. So if the market is overwhelmingly short, you have a ton of future buyers just waiting on the sidelines, because people who are short are not going to stay short forever. They are traders. Investors go long and traders go long. Investors do not sell short. Traders sell short. That means you can go long as a trader or an investor, in other words, short term or long term. But there are no long-term shorts. No one's going to short a stock for 10 years because markets go up more than they go down. That's all there is to it. You get 4 or 5 years, right now, a 10-year rally, and then you get a 1 year crash or a 1 year, 2 year pullback. All right. Carlos says, why is gold still going with such a strong market? Throw correlations out the window, I think you got to say. And you put down GLD. I'm going to go GC, which is the futures. Look at that break. That's what we were watching that for forever. And, I'm remiss that I didn't revisit this sooner. But you look at that break. I drew that trend line saying when that thing breaks, it's going to be time. And lo and behold, it is broken. And it's off to the races. It's kind of funny to me that it's happening now at a time of year when most markets are, fairly quiet. But then again, low volume does not always equal low volatility. In fact, low volume can create higher volatility. There are fewer buyers and sellers. It means and a buy order can move the price farther, and a sell order can move the price farther too. But I would say this also, that the dollar is falling. I don't know if I'd throw correlations out completely. I mean, the dollar is clearly falling, correct? The US dollar is falling, which means theoretically you would need more dollars to buy an ounce of gold. Also, as US dollar is falling, Australian dollar is rising quite nicely, right? So it's good news for Australia, as the price of gold goes up. And maybe Australian dollar also rises because of hope on a China deal. I'm still skeptical, gang. So I don't know if it's throw correlations out the window. You do have Aussie rising and gold rising, which is normal. You have gold rising and dollar falling, which is normal. But you do also have gold and stocks rising together, it's not abnormal, I guess. There's not a very strong correlation there. I would say that a very old school way of thinking was that when markets start going down, everybody would get out of stocks and buy gold. But I don't know if that's the truth anymore. I think people have become more prone to buying treasuries as opposed to gold over the years. When I say people, I'm talking about hedge funds. I think maybe it's just easier to deal with treasuries. At any rate, this is a nice breakout on gold. Let's take a look and see if silver followed along, because if it didn't, we might have an opportunity, right? Yeah, silver kind of did go along with the ride. The chart's not quite as clean with silver, and silver does have a big sort of resistance, like we're right in the face of it right now, actually. Okay, so it looks like silver is at 18. It's a little above 18. Maybe $18.20. I think silver has to get above. Silver could really fly here. The thing that has to happen for silver to take off is the public has to notice. The public has to notice. And also right now, I think the public is probably pretty enamored with stocks. And that might hold silver back a little bit. But if gold breaks, silver should go too. But yeah, the public has to be pretty happy with the stock market right now. I mean, there's no way to argue that. I mean, S&P is up, gosh, close to 30% this year. Let me just check it. And people become complacent and they say everything's fine. And of course, yeah, we're up 29% and change year to date on the S&P 500. People become complacent.
CNN.com.
Oh,
CNN Business, Markets, Tech, Media, Success, Video, Year 2020 inches financial resolution.
my iPad just started reading the CNN page in Spanish. Interesting. Anyway, yeah, I think 1820, 1825, you could see silver really take off here. There's clearly some resistance, a little bit higher. Looks like right there at 1868, and then right here at 1935. But if gold continues, silver will follow, and that might be the one. You know, the thing is, retail tends to buy silver because they can't afford gold. So they tend to buy silver, which gives you an advantage that if gold takes off, there will probably be a lag time. Institutions buy gold and individuals buy silver. And so that very often there's a lag, and that the retail sometimes doesn't get on board until it's too late. So if you see gold taking off, continuing to take off from here, I think the play is to buy silver perhaps, and then it breaks above that line, it should fly. We'll see. We're about to find out. Also, be aware of this. Something I noticed a long time ago. Gold has a tendency to behave very strangely at the beginning and ending of calendar years and at the beginning and ending of quarters. Now, I haven't checked this in a while, so, and here I see at the end of October, nothing exciting really happened. But look at July, right? There's January, February, March, April, May, June. So end of June, look what happens. Big turn in price. At the end of here's the end, the very end of the second quarter. Gold was moving which way? It was moving lower. And at the very beginning of the second quarter, huge directional change. Huge directional change. Why does that happen? I don't know. It's just something that I've noticed over the years. And it doesn't happen every quarter, but it certainly happens often enough. If you go back through the years, you're going to see that there was you're going to see that there was numerous instances. You got to go back a few years to find this. But if you just do what I did, just go back to the beginning and ending of quarters and the beginning and ending of calendar years, you're going to see significant moves in gold and significant directional changes, all seemingly based on the calendar. Right. So maybe they're getting a jump on it. Maybe it's taking off a few days before the end of the quarter, end of the year. But I think gold looks pretty good here, and maybe silver even looks better because silver hasn't really gone. Carlos says last significant correction of the market was back on September 19th. Are we talking significant correction this year, or let me just take a look at. Yeah, there's big dips in there. Yeah, September, maybe August or September. Yeah, September 2019. Yes, Carlos, I see it. The thesis we developed, the trade needs to match the technicals. As far as the pullback in S&P, and okay, so gold also pulls back at the same time. Interesting. So okay, there's a risk on element to both stocks and gold, and gold used to be thought of so strongly as a risk off element, but really, stocks and gold moving higher together all of a sudden. But really, I don't really see that strong of a correlation. I mean, gold had a big setback there too, but man, stocks recovered and gold is just getting around to it. Okay. Carlos says the thesis we developed the trade needs to match the technicals. I do agree. And one thing I know for sure is when Carlos talks, man, you guys should listen out there. Man knows his stuff. Okay. Ah, man. Look at the time. This is going to be my last segment for the year, but I'll be back next year, which is very soon. One thing that's interesting to note, I believe that Friday of next week, we are not getting non-farm. If I'm not mistaken, non-farm should happen on the 10th of January, which is the second Friday of January, just in case you're wondering. So it looks like we are not getting non-farm payroll on January 3rd. We are getting it on January 10. I thought that was interesting. So I think that that's something that we should not ignore. As for next week, we are going to get a ton of PMI numbers. And of course, there's the New Year's Day holiday. So expect low volume, but sometimes low volume can mean high volatility. So, um, and folks, I say to you, first of all, it's been a real pleasure of wrapping up another year here. Just to make sure everybody is back. Yeah, wrapping up another year at FX Street. And thanks, FX Street, for giving me a platform to talk about the things I enjoy speaking about. And thanks to everybody who comes and listens live. Thanks to everybody who watches the recordings. I know there's a lot of you out there. So thanks again, everyone, for another wonderful year. I'll see you next year. This is Ed Ponsi on behalf of FX Street. Have a wonderful day.